benchmarks. You all must have seen that this rating of the clients, you must have seen AAA, AA, A, BBB like that. So we will not take exposure on a client, particular industry if it is less than AAA. Where industry, in particular industry, there will be risk very more. So I will not entertain any proposal if the client is not rated AAA in that industry. So like that, certain benchmarks are fixed in the policy so that we control risk that way. Then grid approval process. There's a grids, approval grids. In every branch, every regional office on treasury, there is a credit approval grid consisting of 4 or 5 members. Then they will decide whether to go in for this proposal or not. So that way there is a wisdom. There is a wisdom, collective wisdom in deciding whether to go in for proposal or not. Similarly, there is a credit risk rating framework. Every bank has got a rating, internally developed a rating framework. And every client is rated where he falls, and accordingly, if the rating is good, then he is entertained. If the rating is bad, lot of risk mitigation measures are taken before financing. Then similarly, portfolio management. Every portfolio is constantly valued and reviewed so that we don't get into too much of exposure, particularly when a portfolio is not performing well. Then credit risk rating, it helps in the evaluation of the borrower on the basis of certain parameters like the degree of reliability and risk. Then we can, if the rating is bad, we can even reject also. Then even if particular sector is not doing well, we may not entertain many proposals unless the client is very good. Similarly, concentration. Suppose if a same client comes for some additional exposure, already we have got so much of exposure, if it is beyond the limit, then we will not entertain him because concentration risk will be there. Then deciding exit point also. In some cases, when we have the information the client is not doing well, we may decide to even exit. We can ask the client to pay back the money by going to some other bank, because our bank we will not be in a position to continue this. Even though this account is performing, for certain reasons, for the information which I have got, the account may become bad, so I can exit. So this kind of facility is also there. Then credit risk rating, it facilitates monitoring of exposures, then fixing outer limits, then pricing also. Suppose a AAA rated customer can command a better pricing. If we charge interest rate, he may also ask for a higher rate of interest. So that's also when it displays the pricing, the rating helps. Then application of risk capital. Here, the risk-based pricing, some of the clients, if many clients come to you with AAA, they ask for low rate of interest, then bank also may not accept, because we should have more interest. We should, unless we take this, we don't have reward. So we will encourage even a lower rated client, say A or B, BBB or B, as long as the advance is well secured, so that I will get more interest. So the philosophy is, if the rating is worse, then you get a better price. You give, you charge more interest rate. So it means your revenue is increasing. So higher the risk, higher the reward. So that way also, the banks will not be interested in lending only to AAA customers. We will lend for lower rated customers also, as long as you take care of the risk mitigation. What happens? Then this credit risk rating model take into account all these components: financial risk, account operating risk, management risk, industry risk, business risk, and product risk. For this, we have got our own software, where if we feed the data about a particular client, that will give the final rating. Every bank has got some software or other. In our bank, we have got it developed internally, and then all these risks are captured, and then after filling all the data, it takes only 20 minutes for each account. Then if you fill up all the data, it gives an output. The client is rating AAA, whatever. Depending upon that, we take the decision. This is the rating system. But this is also a commonly used rating nomenclature, internationally used. See, after giving the marks for various parameters which I showed you in the previous slide, the clients are rated. If it is 76 and above AAA, then AA, A, BBB, like this. The risk description is also given, risk perception is also given. Suppose, again in the policy also, we take care that up to which, suppose a new client comes, up to which point I will entertain the proposal. That is also defined in the policy. For example, in our bank, BB, there is high risk. If a client even comes BB, we take care. I mean, we allow them as long as the suitable risk mitigation is taken. Then we will insist on a higher rate of interest, higher collateral securities. So we have to ensure that our better guarantors. So all these things are insisted upon. So that way, this is what's called a benchmark. So we fix a benchmark for deciding a client, even though the risk is little high. But at the entry level, we will not take B. B and C are not taken. Suppose if I have given to any BBB client, if over a period of time, he must have come to B and C. But when I take a fresh, I will not entertain B and C. My benchmark is BB. Below BB, we will not take. So these kind of policies are there in different banks. Accordingly, the client selection is done. Then if it is a default, once it becomes NPA, it's called a default. So substandard, doubtful and loss assets. So on these, this is what is called NPA, or in other words, it's also called impaired assets, on which no income is recognized. We are not allowed to charge interest, so because it is a non-performing asset. So it impacts the profitability of the bank. So if non-performing assets increase, your profitability is affected. Then risk pricing. Risk pricing is done. Suppose for AAA, I will be giving a very good rate, say 10%. Now, if it is AA, maybe 10.5 or 11. But all these things are decided based upon certain factors like probability of default. What will be the probability of a AAA client defaulting? The probability of a AAA client defaulting is much less than the probability of a A-rated client. Like that. So there are certain statistical methods available to compute the probability of default, loss given default, exposure to default, and expected losses in a particular portfolio. I can compute the expected losses in a group of AAA rated borrowers. Say in our bank, if my credit portfolio is about 50,000 crores, out of that, I will say how much of AAA. So I can compute what will be the probability of loss, expected losses in this AAA. Rating grade wise, I can compute the loss. There are statistical techniques for this, so which we are applying and we are using it also. Then again, rating migration. How you manage a particular portfolio. I will see every quarter how my AAA clients have moved over the last quarter to this quarter. Whether there have been, suppose if I had 1,000 clients in AAA rated, now this quarter end how much I have? If I have 1,100 or I have 800, if it has come to 800, it means there is a deterioration. The rating migration has been bad. So many AAA have come to AA again. So that's why rating migration also helps. Then if we also have a discriminatory time schedule for if a client is rated say low, for example say B or B, then we try to review the accounts once in 6 months. Normally it may be once in a year we will do it, but in this case we do it once. Periodicity is reduced. Periodicity is increased rather. So instead of doing once in a year, we do it twice in a year, so that there is no further deterioration in the health of the client.